Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Monday, September 19th, 2022, and I'm pre-recording this Trading Places Live for Tuesday, September 20th. Currently, we have futures a little bit higher after the nice rally on Monday in the afternoon. We do see Dow futures currently up 37, S&P futures up 5 1/4, NASDAQ futures up 20. So nothing huge, but at least here in the evening on Monday, we are seeing some improvement. We'll see if that carries over overnight. Crude oil currently down fractionally, down at about 85.50 a barrel. And the U.S. 10-year Treasury yield currently at 3.48%, down slightly from the close on Monday. Let's go ahead and take a look at the agenda for today. I'm going to jump into the daily market recap. Talking technically, I'm going to break down the QQQ for you over the last, probably about 10 months or so, maybe 10, 11 months. If you haven't seen the way the QQQ is traded, I think you'll find this pretty interesting. I've got it updated through Monday's close. Then earnings spotlight, not a whole lot to go on there. And then the three you must see. I'm going to actually look at three companies that will be reporting earnings later this week. Taking a look at their charts, I think they all look a little bit different. I think that will be interesting for everyone to see. Before we jump into all of that, though, let me take you over to Earnings Beats. For those of you who are new, if you go to earningsbeats.com, scroll down, have a free newsletter, the EB Digest, which is published 3 times a week, Mondays, Wednesdays, and Fridays. We try to get that out around 8:30 in the morning, which is about an hour before the market opens. We focus on things that are important to us at Earnings Beats. So it's going to focus a lot on earnings, gaps, relative strength, candlesticks, trend lines, moving averages, those types of things. If you're interested, all it takes is a name and an email address. There's no credit card required. You can unsubscribe at any time. I think it'll add to your repertoire as you trade or invest in U.S. equities. So again, just go over to earningsbeats.com, scroll down, find these boxes here, and just type in your name, email address, hit that subscribe button. We'll get you started. Moving on to the daily market recap. The Dow Jones Industrial Average finished up 197 points on Monday. S&P 500 up 26. And interesting, closed at 3899.89, just below the 3900 level. So we broke down. We have not been able to reclaim it yet. We'll see what happens on Tuesday. The NASDAQ up 87 points. So on a percentage basis, did a little bit better than both the Dow and the S&P, which is strange considering that the 10-year Treasury yield did close at a new 11-year high. Mid caps up 29 points, or about 1.23%. Small caps up 11 2/3 points, slightly more than 1%. All of them having a really strong day, at least based on or relative to where we started the day. All the AD lines turning up. I think this is a really good signal. And when I get into the breakdown, the QQQ, you'll get a sense of what's been going on, which I think is kind of eye-opening. Looking at sectors, discretionary stocks led on Monday, gaining 1.2%. Materials up a little bit more than 1%. Industrials up about 0.9%. Both materials and industrials, you can see, continue to be under some pressure. Discretionary is still holding the lows that were established back at the beginning of the month. So I think discretionary has held up really well. And considering the bearish action in the overall market, I find that to be bullish. I like to see discretionary performing well in a down market. So I think that's been a good thing. Real estate also has not been performing well. So you look at what's been going on with materials and industrials. Well, real estate, maybe even a little worse, getting down very close to the June low. Of course, real estate is one of the hedges against inflation, and yet real estate not really doing well, gold not doing well. These are two very, very key hedges where we normally would look for some strength during inflationary periods, and we're not getting it. I think that's important to at least keep in mind. Energy, not very good on Monday as well, down a little over 1%, falling back below the 50-day moving average intraday, but then coming back up and closing above it at the end of the day. So that was good. At least we had a little bit of kick save there. I'd be careful if the XLE loses $75 on a closing basis, but for now, energy does look to be okay. A 10-year Treasury yield. As far as economic reports go, the FOMC meeting will begin Tuesday morning, and it will culminate in a policy decision on Wednesday afternoon. I think everyone is expecting that we're going to see at least 75 basis point rate hike. There are some who think we might see a full percentage point. I am not one of those. I think they'll stick to the 75 basis points, but this Fed hasn't been totally predictable. So we'll see what happens on Wednesday. As far as their policy statement, I think they're going to continue to say, hey, we're data dependent. We're going to continue to look, but we're going to be vigilant in fighting inflation. I think that's what they're going to say. I think that's what the market's expecting them to say. And so unless they come up with something that's really far off from that stance, I think this will be treated more of maybe a relief rally after we get past Wednesday, because at that point, we'll have the two key inflation reports behind us, we'll have the Fed behind us, and then the market can begin to look toward earnings. I don't know that the earnings are going to be that good. I think they'll be okay. I think some areas obviously are going to do better than others, but the market still will anticipate that. We have historical precedents that the market tends to run up heading into earnings season. And once we get the Fed behind us, I think that will give us an opportunity maybe to do just that. The 10-year Treasury yield, you can see, did close at 3.49%. That is the highest close that we have seen since back in 2011. So I'm not sure what's going to happen after this Fed meeting. I think if the Fed does what's expected, 75 basis point hike, and just the same old terms of being data dependent and being vigilant and fighting inflation. I think the market's expecting that. And so all of the selling of bonds going into this meeting, maybe we see some buying afterwards and the yield coming back down. This is a key area of resistance, so this would make sense for the yield to maybe pull back after the Fed has finished its policy statement on Wednesday. I do think we're going to see some volatility in both directions. I think we could see some whipsaw action on Wednesday, but I think ultimately we're probably going to hold this 38.50 area, 38.40, 38.50 to the downside, and I think eventually start to trend back higher again on the S&P. We'll see. All right, moving on to the talking technically segment. I always like to look at the S&P 500. Well, here was your breakdown below 3,900. We have moved back up, closed just under 3,900 on Monday. I would be watching a couple things to the downside. I think these recent lows down around 38.40 or so is definitely worth watching. If that doesn't hold, then we're looking at the lows of maybe around 37.50 from late June, early July. Ultimately, the big number, I think, is still that June 17th bottom. I still believe that holds, and I'm not at all worried about it breaking back down beneath that level. Could it happen? Sure. And, one of the things I'm going to talk about a little bit later, there's a question that came in, what would make me think that this is a secular bear market versus a cyclical bear market? I want to show you a chart on that in a little bit. But right now, watch the 20-day moving average, which is declining. We have a PPO that's put in a new low. That generally means to me the 20-day moving average is key resistance. Now, if we're going to continue to sideways consolidate, then moving averages can be thrown out the window, and we're probably just going to see the PPO meander back and forth, probably below the center line for at least the short term. Technology. Just wanted to point out a couple of these key sectors. So technology, discretionary, communication services are three that I certainly would keep an eye on. Technology, the low down in June still holding, 125 down to that 122 area, I think is the key support zone for the XLK. I believe we'll continue to hold it. Although, if there was a bearish component to all of this thing that really continues to maybe keep me up at night about my bottom call in June. It's technology, it's semiconductors, software. We're going to look at those in just a minute. But I do like what's going on with discretionary. Discretionary, you can see the low that was printed right at the beginning of September. We're still holding that, even though the S&P 500 has moved to a new low. So discretionary stocks continue to do well, and you have to at least scratch your head, even if you're in the bearish camp, and wonder, why is discretionary performing well? I mean, inflation is not good for discretionary stocks. Higher interest rates is not good for discretionary stocks. A recession is not good for discretionary stocks. So why are they trending higher? Well, that's one of those questions. You know, some questions the bulls have to ask themselves, like why are semis and software stocks not really participating? Well, for me, one of the questions I'd be asking if I was a bear is why discretionary stocks continue to perform well on a relative basis. Communication services, in addition to semiconductors and software, I throw internet stocks in there too. Those are the three groups, very, very aggressive groups that would tend, you know, in a bullish market, it would tend to go higher. So you would think that they would be getting their fair share of some rotation, and they have not. So those three groups are certainly three to keep an eye on. The XLC, which houses the internet group, you can see has broken down below the June low. This has been, in my opinion, still is the worst area of the market. I don't know exactly what's going on, but I don't really like to argue with the technicals. We broke down to a new low, went below the June low. Obviously, the S&P 500 has not gone below the June low. So what's going on with communication services? I don't know, but I'm a momentum trader, and I'm really just not interested in this group until we start to see strength. All right. Semiconductors. So the semiconductors have been weak, but one thing that's very interesting, a lot of hollow candles. And look at the AD line breaking to a new high. I mean, here we are at a 9-month, 10-month low, 9-month since the beginning of this mess started at the end of 2021. And yet semiconductors are breaking out in terms of the AD line. To me, that's a sign of accumulation. Now, you can't ignore the fact that we've been down from 97.50 to 57.50. I mean, that's 40% drop. So it's not, you know, if you're trading semiconductors, your portfolio has been getting hit. AD line, you can't go to your broker and say, hey, the AD line's still strong. Can you give me my money back? Yeah, that's not going to work. So we do still have some issues. We need to hold on to the support, but I do find a bit of solace in the fact that the semiconductors AD line continues to be strong and strengthening. Software, very similar. Software down close to the June low, not quite there, but pretty darn close. Another one where the AD line has remained pretty strong. So are we being set up? Is there a little manipulation? Are we moving lower, but institutions are accumulating? Well, we'll probably know more about that, and we'll probably get that answer later in the year. Internet stocks. Well, no, this one's not as strong. I mean, we definitely have broken down beneath this quadruple, actually quintuple bottom. Excuse me, 2,300 level. We hit that level in May. We went back down, tested it mid-June, again early July, again late July, and then again beginning of this month in September, before finally succumbing to all the pressure and breaking down below 2,300. So internet stocks, I mean, say what you want about them. They don't look good to me. I would continue to avoid them. If you do trade them, they'd be very short-term in nature, at least from a long perspective. I wouldn't be that interested until I see this group trading back up above the 20-day moving average. So it's going to take a little bit of work. All right, I'm going to show you a breakdown of the QQQ. And to me, this is just crazy the way this is traded. Now, this is just research that I've been doing. I really enjoy getting in, digging into what's been going on in the market, trying to figure out the market itself and just help our members at Earnings Beats and all the folks listening into the shows where I can. Now, you can take this information and you can do with it what you want. If you want to file it, in your garbage bin, that's fine. I'm not telling anyone that they need to use this, but I find it very interesting, and I think it helps to explain a lot about how the stock market works. So I'm going to start off with this period over here, which I called the bearish manipulation phase. And that was in December when the S&P 500 went up and set a new high, remember? Beginning of January, set that new high. Well, the QQQ from the November high or November 19th close of 402.20 right there. I'm going to walk you through from there to this close right here on Monday of 291.05. We've been down $111.15 on the QQQ. And I'm going to walk you through these three phases to show you how the QQQ is traded. During this, what I call bearish manipulation phase, this is the rotation. This is Wall Street getting out without telling anyone. During this period, the QQQ went down a total of $1.79. Not exactly a big move to the downside. However, opening gaps went up $6.31. The 9:30 to 10 o'clock in the morning, half hour, the first 30 minutes of trading, we saw it go up another $2.30. So during this period, gaps in the first half hour of trading accounted for an increase in the QQQ of $8.63. From 10 to 11, we lost $19. 11 to 4, we gained about 9 of it back. So that from 10 o'clock to 4 o'clock, we actually saw distribution or selling of about $10. And that's what netted here. Now think back to where we were at the end of November. The market was very bullish. Everyone thought, hey, market couldn't go down. It's just going to keep going up, up, up. And so traders were trained to continue to chase gaps. It's what's been working all year long. Why not continue to move up, continue to buy? And yet, after 10 a.m., the buying started to dry out while everyone else was trying to buy. I think institutions were selling. And that's where the net reduction came in from 10 o'clock to 4 p.m. I think Wall Street was getting out during this period while encouraging the retail traders to continue buying. News was still good. Everybody feeling good about things, gapping higher, trading higher in the morning. And then the rug was slowly being pulled out. Then we got to January 3rd. And on January 4th, had a big down day, big reversal in the market. And that started this 4.5 month long period of distribution where the QQQ dropped $112.28 during this period. Opening gaps accounted for nearly $30 to the downside. 9:30 to 10 a.m., $35 to the downside. 10 to 11 a.m., $33 to the downside. 11 a.m. to 4 p.m., $15 to the downside. Every period, we just saw selling essentially throughout the day on a net basis during this period. That is how you get distribution, not just gaps to the downside, but real selling from 9:30 in the morning until 4 p.m. We saw that through May. Since then, I saw the rotation back in mid-June. That's the reason I called the bottom back in mid-June. But since that May low, if we go from the close on May the 20th, so beginning on May 23rd, and we go from there through where we finished on Monday, September 19th, yesterday, the QQQ during this period went up $2.92. Didn't do much. Just like the bearish manipulation phase here, we didn't do much, but it was opening gaps higher and then selling. I want you to look at what's happening or what's been happening for the last 3 or 4 months. Now, I know some of you think, oh, we're just going to keep going down. We got momentum to the downside. We're going to collapse. I don't think we're going to, and this is one of the reasons why. The opening gaps. Now, remember, we've been in this bearish phase. Everybody's bearish. The news is negative. Everybody's bearish. Opening gaps. During this period, when we've gained $3 on the QQQ during these 4 months. We've gained $3. Opening gaps, we've lost $41. 9:30 to 10 a.m., first 30 minutes of trading, we've lost another $11 of trading. We've lost another $11 on the QQQ. So between opening gaps and the first 30 minutes of trading, during this period when the QQQ's gone up $3, the opening gaps in 9:30 to 10 o'clock, $52, almost $53 down on the QQQ. You can call it what you want. You can ignore it if you want. I think it's the media. I think it continues to set analysts, Wall Street analysts, everyone's still talking about inflation, interest rates, how it's going to be horrible, the recession, the negative GDP. Oh my gosh, this is awful. And everyone's buying into it, sending the market down early. Then look what happens the rest of the day. 10 to 11, we go up $5. From 11 to 4 o'clock, these 5 trading hours for these 4 months, the QQQ's gone up $51. So everybody's selling in the early morning. And while everyone just keeps trying to sell, institutions are accumulating. Market makers are buying. Now, you can interpret this however you'd like. That's the way I interpret it. I think Wall Street is using the retailers once again, just like they used them back here. Everybody thought everything was great. We were gapping up. Wall Street was starting to get out. Then we went through this entire distribution phase, and now we're in this bottoming bullish manipulation phase. And again, you can look at this and ignore it. I can tell you one thing, this has been a godsend to traders, anyone who's been at earnings beats. We've been talking about this for a while. Don't buy at 4 o'clock. Don't buy any of your favorite stocks when they're rallying in the afternoon. At least that's been the strategy of late. Wait and buy at the open or in the first 30 to 90 minutes. That's when you're going to get your deals. And then do what the market makers are doing. The more you can get yourself on the side of the market makers when you're trading, the better you're going to do. Market makers make money, and they do it at our expense. So you can take this for what it's worth to you. Maybe it means nothing to you. Maybe it's fascinating. To me, it's fascinating. But anyway, I just wanted to share that. Let's move on to a question that is asked of me pretty often of late, especially since I turned bullish back in June and said that this was a cyclical bear market. By the way, I called the cyclical bear market back in December. It wasn't like I waited until we went down 20% and called it. I expected the market to have a really rough first half of the year, and it did. But I expected it to be cyclical in nature, meaning short term, not secular, which is long term. These red shaded areas show you this is a 100-year chart. You can see what a secular bear market looks like. It is bad. 1970s, 2000s with the dot-com bubble, the financial crisis. We went 13 years without setting a new high. I think we may have in 2007 gone slightly above, but essentially there were no meaningful breakouts for 13 years. 13 years. 1969, well, we went up, put it in this high in 73. But it took us from 73 to late 1980 to get back to a new all-time high. That's what secular bear markets look like. Move down, bounce, another move down, usually a little bit lower, bounce, and then finally we get out of that wicked market behavior. Same thing here, down, we bounce back up. That's a cyclical bull market. Then we go back down again, and then we start the next phase, finally break out and start a secular bull market here. That's what these blue directional lines are. We go through normally about 20-year periods of climbing equity prices in the U.S., and that is a secular bull market. So what would make me think this is a secular bear? Well, number one, you don't normally have a secular bear for 13 years and then rise for less than 10 after a breakout and then go into another secular bull market. That has not been our history. So number one, I don't expect it. We had gone up way too far too fast. And I was looking for a pullback into basically a trend line. If you connect the highs, you connect the lows, you'll have basically a channel. And if you connect the midpoint in between, you'll connect a lot of these intermediate lows. And that's what I was looking for. We did that in June, and I think we're now top or bottomed and we're going higher. So what would change this? Well, number one, to get a secular bear market, the monthly PPO has to go negative. It did so here at these lows. Before those lows, I mean, we went negative and then things really accelerated. Same thing back in the 1970s. Notice in the 60s, 80s, 90s, and the last 10 years, when we've had cyclical bear markets, the PPO, monthly PPO, goes back to zero or close to zero and then turns right back up again. So I'm expecting us probably over the next couple of months, this will continue to drop until we get some more momentum going to the upside. I think we're going to get probably close to the zero line over the next few months, but that can keep going lower even when prices start to go higher. That would be point number one. Point number two, if you look at the monthly RSI during secular bull markets, very, very rare to see a move on the monthly RSI below 40 in a secular bull market. We had two very, very brief breaches back in the 1960s. We have not had another one since during a secular bull market. Back in the pandemic, March of 2020, you can see we went down to 40, never went below 40, bounced right back up. Recently, in June, we were down in, I don't know, maybe around 46, went back up a little over 50. Now we're back down to 48, still well above 40. Secular bear markets don't happen without going negative here and below 40 here. So that's what I'd be looking for. All right, earnings. AutoZone, just wanted to point out, yesterday they came out with earnings on Monday morning and gapped up, but then sold off. I actually think this is going to hold. I think we're going to hold around this 2060, 2070 area. And I wouldn't be surprised to see AutoZone move back to the upside. Now, for the three you must see, I'm going to give you three stocks that will be reporting. They will be reporting this week. General Mills, this is a stock. 80 line looks great. Relative strength versus food products looks good. Food products is fine. Been kind of going along for the ride with the S&P. It's not underperforming. So you got a strong stock in a decent group. I like it. I wouldn't be surprised to see a decent report coming out of GIS. Lennar. Now this one's interesting because the 80 line's been starting to falter. And when you look at this, Lennar has been struggling for about the last 5 weeks on a relative basis, and the group's been struggling. But Lennar did show a lot of strength back in this period from June through August. So you got a stock that's doing okay within a not so great group. I don't know. I'd be a little cautious. I don't think the numbers are going to be good, and we'll just have to see if Lennar gets a positive reaction. The last one is TCOM. TCOM 80 lines looking pretty good, but we've been seeing weakness the last 3 months or so on a relative basis, but the group is strengthening. So this is a stock that's struggling a little bit within a group that's strengthening. I don't know. This one's a mixed bag. Watch $24. I wouldn't like it if it closes below 24. All right, that's it for me. I appreciate you tuning in. I'll be back on Wednesday over at Earnings Beats for your next Trading Places Live. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.